Welcome back. You tune in to Market Fatafat with me, Ankita Saxena, and with me, Sharad Dubey. And we're getting you all the top buzzers in the trade today. And on the technicals now, we're joined by Raj Deepak Singh, who's the analyst derivatives from ICICI Direct. Hi, good afternoon to you, Raj, and thank you so much for joining us today. Raj, you've picked out Tube Investment as your first stock. Take us through what does the chart for Tube Investment say, or what are the levels to watch out for?
Hi, good afternoon. Well, Tube Investment seems to be moving out of after 6 months of consolidation, and at the same time, if you look at from the derivatives front, then stock has able to surpass its major call base. And when you are expecting a broad market recovery after being almost range bound to witnessing significant selling pressure in last 1.5 months, so perhaps those stocks which have been relatively outperforming or shown resilience, they are likely to perform better. At the same time, being a holding company also, but overall, the moment what we are witnessing in the auto pack, Tube Investment is also likely to benefit from that, and we believe that the stock might move towards 3,300 levels in the short term.
Well, interesting development coming in. Let's focus on Astral and even Supreme Industries. It's positive news for both of them. DGST has proposed an additional duty on SPVC of 20 to 25% on the Chinese imports. It needs to be approved by the Ministry of Finance for getting implemented, which may take 2 to 3 odd months. But this augurs well for the entire space, especially for Astral and Supreme Industries. Astral is also up almost 4% in the day's trade today.
Right, moving on from Astral, then let's go to the next counter, which is Vodafone Idea. That is in focus on the back of a brokerage note by Motilal Oswal, where Motilal Oswal is they are maintaining a sell call, and the target price for that is ₹6 now from an earlier ₹7. Now they feel that the Q1 was in line, and the debt raise is crucial for long-term survival. They have cut their FY 27-28 revenue and EBITDA estimates by 4% and 5%, each driven by higher subscriber declines. The CEO change of Mr. Akshay Mundra has stepped down as the CEO of Vodafone Idea, and the current CEO, Mr. Abhishek Kishore, will assume the role of CEO from 19th of August 2025, and that's a new development that has happened. The management has reiterated its commitment to 5,000 to 600 crores of capex in the first half of FY 26, and the major capex beyond the first half of FY 26 depends on the debt closure and will be funded through internal accruals until then. Now, Motilal Oswal has cut their FY 27-28 estimated revenue and EBITDA. Like I mentioned, the estimates are by 4 to 5% each, and they're driven by higher subscriber declines. On the back of that, they're maintaining a sell call coming on Vodafone Idea. It has picked up actually from the day's lowest point, and Vodafone Idea is actually now seeing some buying coming in. It is in the green with an uptick of 1%.
Well, yes, the telco space buzzing, of course, and Jio's news flow as well. But Marico is the next stock in focus. Raj, what are your views on Marico? We have seen two important things happening. The copra price is cooling down, and interestingly, the GST rate cut on hair oil, that's expected to come down as well. So what are your views technically when it comes to Marico?
The cut which is expected may bring this overall consumption space in the limelight, and what we are witnessing is the same. So if you look at the Marico, then despite all the market volatility in last 1.5 months, the stock was able to hold above 700 levels. And what we believe, unless it is not moving below these levels, so instead of looking at the hurdle, we are looking at as in support, 700 level as in support. So there could be further upside, and we believe that the stock might move towards 760, 780 levels also. So as of now, stock is in very strong footing. So if you look at the peer comparison also, so across the board, at least FMCG pack is something where we are witnessing least selling pressure in last 1.5 months.
All right, so that's Marico on the charts, but we'll keep with the consumption pack. Exposure in the consumption sector will remain tilted towards quick commerce, and that's the word coming in from Hiren Ved. He adds that the GST rate cuts will mitigate the impact of slower exports amid Trump's tariffs. Let's go across and listen in to his take.
Consumption exposure had moved from FMCG staples to retailers and quick commerce companies, right? Because actually they were growing faster than the staples companies, and I think that's not likely to change in my view. So while staples will benefit, but I think a leveraged play on staples is actually to buy quick commerce and the large big box retailers, I think they should benefit significantly from the volume growth that will ensue as a result of the tax cut. So I think the entire basket should do well, in my view. And people can pick and choose whether they want to buy staples or they want to buy autos or they want to buy the platform companies, which will also benefit as a result of that. I still believe that there is a significant upside to the platform companies because I think that they are clearly a derivative of growth on top of FMCG growth. So I think the whole ecosystem should benefit as a result of this.
Well, yes, bullishness coming from Hiren where on the platform stocks in the consumption space, which is like a derivative of the FMCG pack. Speaking about the potential sectoral impact of GST realization, Venugopal Gare, the managing director of Bernstein, says that he expects positive momentum for FMCG across the board. Let's listen into his views on the other sectors.
When it comes to consumer, there are various verticals. So FMCG is pretty much across the board, right? So you'll get some degree of positive movement across there. Investors can pick and choose their stocks, but FMCG overall across the board, maybe excluding some premium FMCG folks. In consumer durables, remember that quite a few items are already 18% sort of a GST rate. Things like air conditioners are in 28. So perhaps that could come down to 18, which is going to be positive for some of the air conditioning players. But durables overall, remember that there's an indirect benefit as well. If you're transferring in general some wealth to a consumer, it can eventually percolate into purchases of those products, even if their rates are not changing, right? So this is more a consumption buoyancy. So that's a second one I would probably argue. Remember, it's a consumer durables, a range of players, but I'm just calling out air conditioners, given that they are the ones which might see a rate, trickle cut. The third chunk, primarily, I guess, is generic in terms of some spending towards the discretionary areas, especially retail or QSRs, which I've been selectively positive through the year because of other factors as well. Autos, not very clear as to what happens to the rates out there. Very, very tough to be very bold and take a call on that. But in a very theoretical construct, ideally, it should be small cars or small two-wheelers.
All right, moving on then from the consumption basket to VA Tech Vibhag that is in focus. Kanishka, tell us what's the news from VA Tech Vibhag? Why is this in focus?
That's right. So VA Tech Vibhag is in the spotlight today after bagging a repeat order worth about 118 crore rupees from Bahrain's Ministry of Works. Now, this contract is for 5 years of operation and maintenance of the 40 million litres per day Madinat Salman sewage treatment plant and Long Sea outfall. Now, this deal not only strengthens Vibhag's O&M order book, but also adds steady annuity income, improved cash flow and revenue visibility for the company. Now, this repeat order underscores the company's technical competence and strong execution track record in the region, and that's why the company is in the spotlight today. But despite the order win, it continues to trade in the red, down about 0.5% as we speak.
Yes, order win, VA Tech Vibhag and the infra space has been buzzing. Some important positioning on the buy side is seeing in some counters as well. But moving on the pharma space, for the second straight day, the pharma index has been the top loser. And today also in the day's trade, stocks such as Cipla, Sun Pharma and Granules India are on the lower side. They are trading and they are in the red. Now, interestingly, the overall markets, the small caps, the mid caps, all have been buzzing in trade, but the larger players in pharma have been seeing selling for the second straight session. It's a divergent trend as compared to the markets, as till now there's a tariff uncertainty coming for this segment as well, and this will continue until this overhang is not completed, at least till 27th August, as overall still the exposure which is there, that is on the higher side. Almost 50 to 70% revenue for large players in the generic segment comes from this segment. But do remember, the weight loss drugs are also coming in, and that would augur well for certain counters as well in the pharma space.
All right, moving on then from the pharma space, Raj Deepak, you picked out NCC for us. On the charts, what do you see for NCC? The stock is down almost 20% year to date. But from here, what do you see? What are you penciling in for NCC?
See, it's a very particular and I would say exciting name. The reason being, the stock hasn't done anything. If you look at it from 3 or 4 months perspective, the stock hasn't done anything. What we have seen couple of days back that there was a strong delivery based buy, but at the same time, the huge option build up at both ATM and OTM call strikes that was humongous. So. Significant direction move is what I'm expecting towards the expiry, that is the next week. So perhaps I wouldn't buy at CMT, but what I'm recommending here is that if one can look at buying if stock is moving beyond 225 levels, so that would trigger a significant short covering at least among the call writers, and overall what we have witnessed in the delivery segment, that we believe that there won't be much decline from here onwards. So perhaps a move beyond 225 should give this stock a further momentum towards 240 or even higher levels.
All right, with that, it's time for us to slip into a short break. Don't go anywhere. After the break, we get you more buzzes on the other side. Stay tuned.